Welcome back, everybody. We're talking, here we are at the early part of July 2020, and we have another update for you today. So let's go ahead and do a round of quick introductions. We'll start with Malieka, then Tom, and then we'll kick it over to Mike to talk about the economic outlook.
Hi, I'm Malieka Bordigioni. I'm a research manager at the University Center for Economic Development, and I also work on the FAPRI project.
I'm Harris. I'm a professor in economics and director of the University Center for Economic Development, state extension specialist also.
All right, Mike.
And I'm Mike Helmar. I'm also a research manager with the University Center for Economic Development and the UNR Agricultural Experiment Station. And along with Malieka, I work on the FAPRI project.
Great. All right. So how are we looking in terms of the economy, Mike?
Well, not good. I want to take us through, I got PowerPoint to show, and I want to take us through kind of a comparison of what expectations were 6 months ago in January and where they are and where things are looking now after the pandemic has hit and we've gone through some gyrations in the economy, and we've had an opportunity to try to make some educated guesses at where things might be going. That's been a problem up until this time. Everything was in such a flux that we didn't really have an idea of how to get a handle on where things might be going. We now do have an ability to do that. How accurate it is anybody's guess, and that depends on what happens with the pandemic. But if we're ready, I'll start in with a PowerPoint. All right, so what I'm going to do is we're going to talk about a Nevada agricultural outlook, which we normally put out in March or April. But again, this year we had no idea where things were going. And this year we're going to do things a little different. Rather than just give an outlook, we're going to do this in the context of comparing it to, we did some analysis on it here this last month. And we're going to compare it to how things would have looked in January compared to how they look today. And we're going to concentrate on the impacts of COVID on the cow-calf dairy and alfalfa hay sectors in Nevada. So here are the things that shape our baseline that kind of give us the contours of what we want to talk about. First and foremost right now is COVID-19. The coronavirus is basically trumping everything from health to the economy. And I want to remind us that what's going on with our ag markets and with any markets right now didn't start primarily as an economic adjustment to anything, but it started as a health issue. And the economics kind of were pushed along with it. They're the fallout from that. They're a symptom of it. So COVID-19 is the big driver of everything that we're looking at now. And then we do have, of course, it's not the only driver. We do have the global economics and population. We still have policies in there, trade policies, so tariffs and export taxes, including the phase 1 implementation with China. That's kind of been an on-again, off-again sort of thing. China is making at times attempts to abide by what they said they would do. But right now it's really difficult when you have some reluctance to import, to bring items into your country. And China's not the only one that's doing that, but phase 1 implementation is still in there. And then we have global area and of course US area, how area can expand or not, and yields. It's a technology factors, how yields are expanding. So that shapes the baseline. Then the supply chain. Malieka covered the supply chain a month or a month and a half ago in one of these podcasts. What's happening in the supply chain? We usually just have taken that for granted in the past, but we no longer can. The disruptions to the supply chain from COVID-19 really affected agricultural markets. Biofuels are still a factor, and then livestock, poultry, and dairy demand growth. So we still have our old drivers of this, but we throw into it COVID-19 and its impacts on things like the supply chain. Now, when we bring it down to Nevada, and we'll talk about this more in depth after we finish the economic one, we'll do another podcast on this. But for the Nevada Ag Outlook highlights, what is really driving it is that the global economy contracting in 2020 because of COVID-19. That affects not just more than Nevada, but it affects the global outlook. Okay, the US dollar ends appreciation but remains strong. So that really goes to our trade positions. And there's so much more in the trade issues now with COVID-19 that international markets have been affected. But then the dollar is remaining strong, which makes us a little less competitive. The long-term purchasing power will increase for importers, but that's going to be a few years out. Petroleum prices crashed due to slack demand that we had. As you and I sheltered in place in our homes, we didn't go anywhere. We didn't drive. We had industrial production reduced, so fuel demand fell very sharply. And then because of that, we had a huge oversupply of not only of petroleum, but of petroleum products globally and in this country. It was difficult to stop production, and it was, where do you put it? And the prices dropped and even went negative for a very brief period of time. Then we have a period of generally low prices for major ag commodities that we expected before in January, but now it's even worse. We have real economic challenges for cattle and dairy in this state and in the country. Our cost inflation will be modest. Grazing allotments are an issue for our cow-calf industry. This fire season could be severe, and as we've been looking the last week or so, we've seen a lot of fires crop up, particularly in northwestern Nevada and other parts of the thing. It's very dry and been very windy. And we're also entering a drought. So fire season could be a real issue that could have some big impacts on the amount of land available for grazing. And then dairy expansion, partly because of the economics surrounding things, has been short of the needs for the whole milk powder plant in the long term. So let's talk specifically about the economic environment. The first chart here that we have here is just taking a very general look at the global economic picture. The blue lines are the world gross domestic product, the percent change from year to year, the growth rates. The red lines are those for the US. You can see the blue solid line is what we expected in our January, when we look at things in January. The blue dotted line is what we are looking at now, or in June and now. And you can see where the black vertical line is, that's 2020, that's where we're sitting this year. And these are our expectations. Back in January, we expected a global growth of about 2.5%. Kind of typical for a mature global economy. Things were going along pretty well. But as we moved into the COVID period, if we look down at the bottom, it's kind of hard to see these two dotted lines kind of go together, but the dotted blue line goes down to about a -5%, a little over -5%. So we're expecting a global contraction in economic activity by about 5% this year. It basically says that we're in a deep global recession. And if it persists any longer, it could become a depression, but we're in a recession right now. And I want to back us up a few years and take a look at the last dip. That is that dip in 2009 of about a 2% dip. That's the Great Recession that we had, that we just came through about a decade ago and recovered from less than that. What we're expecting for this year is even more severe, even steeper than what we saw on an annual basis in the last recession. So this is a severe recession that we're in. Now let's move to the red line, which is the US. Again, the solid line is our expectations in January, and the dotted line, or the dashed line, is what we expect now. And in January, we expected US growth at about 2%. Pretty typical for a mature economy. But now the expectations have gone to about -7%. So that's even steeper than the global economy on average, so that the US economy is really down. And again, it is much steeper than in the last recession. Now, as we come out into 2021, you may say, well, okay, things are all better there. Now, what we're not talking about here is not the levels of gross domestic product. but we're talking about the growth. So that even if we take about a 4% growth for the global economy in 2021 and a 5% growth for the US economy in 2021, remember that's coming off a 5% and a 7% down. So even at the end of next year, we're not even back to the level of economic activity that we had right before the start of this. So it's going to take us a few years before the economies recover in magnitude to what they should have been. And because of this, we're going to see some dampening in demand all the way out for a few years. So we're in a very severe recession right now. And here's another picture. One thing that we don't normally talk about too much in our projections is the unemployment rate, because usually we're looking at projections where things are kind of humming along, and the unemployment rate fluctuates a little bit. But now we really need to take a look at this. This is very, very telling here. Again, we're looking at the solid line of expectations in January compared now to in June. And this is our unemployment rate in percent. So in 2020, we expected a very low unemployment rate. I mean, in January, expected a very low unemployment rate, record low rates, you know, well below 4% for the year as a whole. But now with COVID-19, we're expecting our expectations are about 15%. That was in the data that we got from IHS Markit, which provides our economic forecast for us. Now, a little caveat here. Since we have gotten this data, it's been a few weeks, the expectations aren't quite as severe for that. So back off by 2 to 3% maybe on the unemployment rate on average for the year. But that's still very, very high. Again, it's much worse than it ever was back in the Great Recession, back in 2010 when we peaked out at almost 10%, 9.5%. So our unemployment rate is very high. A couple of reasons for this. One is that as operations shut down in plants and manufacturing and places, businesses closed down, people just physically couldn't go to work. The other one is another round. This was subsequent to that happening. What happened is then demand became down, and what businesses might have still been open saw a shrinkage in demand because of the economics, and laid more people. Expect that to persist into 2021 for a while. Again, we're a little high on these numbers now, and not really come down to full employment until we get out 4 or 5 years. We'll begin to hit our full employment again. This is going to take quite a while for it to completely adjust. So we've got a very, very tough time with a lot of fallout from it still sitting in front of us. And that will have an impact on what happens with our economic activity too, because it has an impact on demand when people's incomes are hit. Now, the incomes haven't been hit quite to this extent because of government bailouts and extension in unemployment benefits, if folks can get through the red tape and get to them. So that's helped mitigate things a bit, but it hasn't made us whole by any stretch of the imagination. So our incomes are still down, so our economic activity will still be hurt. And one of those things, I want to look specifically at things because it's very telling for not only what's happening during the coronavirus, but also impacts for our ag markets. And that's our food spending. The blue line again, we expect that our food spending, this is per capita, and this is in inflation adjusted terms. In 2020, we expected that to be about $5,300 per person per year. But with the COVID thing, we're now down to about $4,900 per year of the expectations. And even being lower, a little bit lower next year before it begins to recover and recover over time. Now, does this mean that we're eating less? To a certain extent, but that's not the major part of this change in food expenditures. It's where we eat and how we eat. It used to be that at least half of our food expenditures were done in restaurants. That doesn't mean that we ate in restaurants half the time, but half of our expenditures were in restaurants, which are by far more expensive than when you when you cook at home and serve your family at home. But as restaurants closed, almost all meals went back into the home. And again, it's cheaper to go to the grocery store and buy your food. So while we may have cut some things out, and may not have been able to get some things, dairy, meat, or some things for a while that were difficult to get, that has since been pretty much alleviated. But as we eat at home, we eat cheaper food. Our expenditures are less than what they were, and it's going to take a while before that to come back up. Now, this has a couple of implications here. One is that it's going to take a while to get back into restaurants. I think this might be a little pessimistic, because as we looked at when things started to open in a lot of states before they started to close back again, people filled what restaurant capacity was allowed to be there. They pretty much did. They went out into restaurants and bars and things like that. They flocked to them. But the other thing is also, with the recession and taking a while to recover from it, that food prices will be down a little bit. So expenditures will be down. And it's going to take us out about another 4 or 5 years till we get back to where, close to where we would have been before this. So food spending has taken quite a hit. And some of that is just because of where we're eating. Some of it is also what we're eating and what's been available to us. But that is an issue for ag, although it's not quite as dire as it appears here, but food spending is down. And then this economic weakness has also induced less oil demand. We're not driving. A lot of industries are shut down or operating below full capacity. And so we're not using the amount of fuel there. And because of that, we're using the West Texas Intermediate crude oil price here as a proxy. We expected it to be an average of a little over $50 this year in January. Now our expectations are about $36. Well, it's kind of there right now, but that's for an annual average, and that gives it room to move up over the year. And so that price is expected to be significantly lower than what it was before. So it's got a couple of implications for it. Some positive, some negative from a global perspective. The positive ones is, yeah, we're spending, not only we're not driving as much, but our fuels are less expensive. And so for things like, and we'll touch on this a little more here in a minute, but for things like agricultural inputs and things that we transport to market, those costs for that are lower and they're cheaper. But for the oil industry, for the petroleum industry, particularly for foreign producers that depend on oil as the major part of their economy, and we're talking about much of the Middle East, we're talking about places like Central Asia, Kazakhstan, Uzbekistan, and places like that, whose economies are driven by the oil price, their economic malaise is going to continue for longer. So they're going to be missing out of some markets. But our oil prices are considerably weaker. Here's another thing that is got mixed implications here, is that the interest rates will help reduce borrowing costs. So we've seen the Fed funds rate and the prime rate drop into 2020 with COVID. It's a way to help try to stimulate the economy, help try to keep consumption up, particularly for durable goods, autos and things of that nature. Those sales are down. Homes, getting mixed reports. Some say that housing markets are still relatively healthy. Some places they're down. But the lower interest rates will help stimulate the economy, not return everything back to where it would have been, but help stimulate the economy to a certain extent. And again, it helps reduce borrowing costs for ag producers. Having said that, our financial institutions take a little bit of a hit on what they can lend at, and you and I as investors, if we have bank accounts, if we're into bonds or anything like that for investors, our returns are going to be severely dampened because of this. So it's a double-edged sword here. But the expectations are that as we move through this, as we've increased our indebtedness, inflation stays in check. So if inflation stays in check, then our interest rates can remain low. And then you look at this and you go, yeah, that's an awful long time not to move them. But let's look back on the curve a little bit, starting in 2009 and 2010. How long did our interest rates stay low, not only during the last recession, but during the recovery of it when the economy was moving along pretty well? So the precedent is there for our interest rates to remain low for a considerable period of time. So borrowing for durable goods, for housing, houses and things of that nature, and even for educational purposes, those rates will remain favorable for a number of years. And I kind of want to, now that we've gone through this thing, I kind of want to finish this up here by taking a look at some very specific ag-related cost categories. The blue bars are our expectations from January. What we expect the average index to be, that with 2015 equaling 100 over the 20 to 25 year period, what that would be. And the red bars are again our expectations now in June. So we can see for most categories, our expectations are that the costs will be somewhat lower over the next 5 years than earlier expectations. The fuel one is a little hard to gather, but part of that is where we started from. And with the fuels and machinery, it seems to be about the same. But for the most part, our costs for our ag producers are going to be expected, not only for goods, but for services as well, are expected to be cheaper over the next 5 years. And why services if there's not inputs into them? Well, if we look at wages, with the dampened economy, with the slack labor market, a lot of slack in the labor markets, we're not expecting to see wage rates rise very rapidly, less rapidly than we did 6 months ago. So our wages are going to be lower than what we had. And we start talking about our services, things like, accounting, banking, even repair services, and those sorts of things that ag producers, like any other business, needs. Those things are very heavily dependent on wage rates. As a matter of fact, if you look at what makes up their costs, the majority of their costs are wage rates. So as we hold wage rates down, even those services costs will be lower. And so for that case, the cost face that agricultural producers will face will be less. Will it be enough to offset weaker demand and weaker markets? Not likely. But this is what the economy is coming down to. It does have some positives in the long term, but right now, for the most part, we're really, really hurting. And that's where I'd like to leave it. If there's any comments or questions from the rest of you folks.
Any questions?
Tom, did you have a question about the phase one?
Yeah, you might explain to people what phase one meant.
Oh, okay. I apologize. I assume everybody knew what phase one. Recalling the trade disputes with China and the tariffs that were placed on many goods, the U.S. placed on Chinese goods coming into this country, and the Chinese placed in retaliation on U.S. goods going into China. They negotiated a start to reopening these things back up and removing the tariffs. And phase one basically said that for agriculture, that in 2020, that the Chinese would increase their imports of U.S. agricultural products to about 19.5 billion tons. Billion dollars, and then up to $40 billion by 2021. So they made some commitments to increase their imports by monetary amounts. As this thing hit, it doesn't make sense to force a country to do that. Although China has tried in some cases to maintain their increases in the value of their imports from us. The big one that was hit in all of this was soybeans. That was 2/3 of the value of our agricultural exports to China. And China, to its credit, has imported more soybeans. Whether they'll be able to meet those commitments, it's not likely because of what's going on with reduced economies and things of that nature. And also with the willingness of countries to open their markets to goods which they feel with contact with people and maybe the goods have some contamination. So phase one is kind of an on again, off again thing. And so it's going to be likely several years before we begin to see the full amount of that agreement fulfilled.
Also, I think, Mike, on your restaurants, I think it's very interesting. I think restaurants are going to see, as with this COVID, I think some people are going to have to realize that there's going to be some changes going on in the economy. As Mark Cuban calls it, economy 2.0. There's going to be some flushing out because it's going to be higher cost. Most of these places have to have more costs for safety and also probably lower revenues because of people coming in. And with that, the restaurant demand, I think, is going to be interesting to me. The consumption, I think, will go lower, but there'll probably be smaller number of restaurants because of you can't. I remember one time in Las Vegas, they were showing some people trying to add like 10% for COVID costs. Well, they started marking it out. People aren't paying for it. And so what happens, restaurateur, people in restaurants are going to have to be very innovative, and they're just going in. The costs are going to have to go up, but also some of the revenue will be going down because you only have 50% capacity. And that's the dynamics. I think we're going to be seeing some changes in how that changes. Our consumption in home and out of home consumption might have changed permanently.
Yeah. Well, you're right, Tom. And to your point, I can go back even a couple of months, and just things that that we all saw on the news were that as maybe it's only been a month or a month and a half, as restaurants were allowed to start opening a little bit. I saw some interviews with restaurateurs or restaurant owners and operators that they were talking just about exactly those 2 points, is that their costs, because of having extra cleaning, sanitizing with COVID, and acquiring PPEs for their staff, that their costs had gone up measurably, and that they were restricted by how many people. They were restricted to 50% capacity or so, that the revenues were down. That I saw several on the news, restaurant owners that said, "We tried it, we've got to close back down until this thing gets completely straightened out." And so that's right, that's happening. And it's not just in restaurants, but some other businesses as well. But the restaurants have been hard hit by that, and some of them have had to make decisions to close back down, or their profits are next to nothing. The real question that I have about this is, as we go forward, as COVID-19 subsides, if we get an effective vaccine that basically COVID is not an issue any more than the common flu is, are these new restrictions that we're seeing and new protocols that we're seeing, are they going to be permanent? Will some people say, we don't need to do this anymore? So that's a question that I don't have the answer to. And I haven't heard anybody else thinking about it. But if we get rid of COVID, somewhere is going to say, then why do we have to do any of this?
I think that will happen, but our consumption patterns might have changed. I think also one of the things, Mike, if I'm a cattle producer, we're all aware of the supply chain problem, the ag meat processing plants, and some of the things, they're going to become more and more COVID related, that means the push through is going to be slower. It is how, where people are thinking about how is that depressing, if at all, cattle prices at the ranch level?
Well, that's, as we went through when a lot of the plants were closed down or were trying to reopen and all, they had to increase the spacing between workers. They had to install the plexiglass shields and things of that nature. That definitely does slow the lines down. But the lines will remain slower. I think some of these things are going to remain in place. Another question that we have to ask: we get rid of COVID, what's the next one down the road? And I think all the health experts and even those of us that aren't health experts are thinking, this probably isn't the only thing that's going to hit us. There's liable to be a lot more of these things coming. So if that's a permanent situation, then yeah, we're going to have slower lines. Either that, or we're going to have to expand the plants, just the physical size of the plants to increase the length of the line so you can get the same number of people in there. And that's a cost, and that's certainly going to be passed on. But the slower lines initially were an added constraint on the number of animals that could move through. So what happened there is less animals moving through, higher retail prices, but we've got more live animals sitting out there on the other end of it before you get into that thing. And if the producers can't move those animals, or if the plants aren't willing to pay a price, the slaughterhouses and pay a price for those things, it just depressed the price. And that's one reason why we're seeing a decrease in the cattle prices. Actually, we saw a decrease in the cattle prices, a very drastic one. They've come back up, and even this week they've bounced up again a little higher, but they're still not as high as they were before, not anywhere near there, nor as high as we actually expect the annual average to be. So we're expecting more recovery in it, and that tells me that we're beginning to move through an adequate number of animals.
So, I think also this may be on another podcast, but COVID-19 is going to change the way we do our economic system. So are people thinking there's going to be some kind of permanent change in the processing industry?
I believe so. There just about has to be, from a couple of perspectives. I think one of those perspectives is that we're just going to have to be more vigilant about health issues in general, have protective equipment there, maybe larger spacing. The other thing is, and it's one thing that we're discussing in Nevada here a little bit, is a change in the size of processing industries. These large processors are very efficient. They can move a lot of animals through. They've got economies of scale, but they've also got a whole ton of people in there that you have a higher exposure to bringing in a pathogen of some type or another. If you have a smaller industry in a not so populated area, smaller slaughterhouse and processor not populated area, you just have less of a chance of bringing something like that in. So it may be that that will provide opportunities for smaller processors to establish themselves in area that have adequate numbers of animals.
Good enough. That's all I have.
I just wanted to mention one thing, and then we can move on to our commodity podcast. But when you were talking about the unemployment rate, and this goes somewhat, Tom, to what you were talking about with the restaurant industry and that sort of thing, is that DETRS, Nevada's Department of Employment, Training, and Rehabilitation, their most recent release, I believe, reported a 30% unemployment rate in the state of Nevada, which I think is the highest that's been reported since they started keeping track of those numbers. And obviously a lot of that is because Nevada economy is so dependent on tourism, but restaurants are indeed grouped in often with that part of the industry. And here in Nevada, a lot of our fiscal revenue is driven by and comes from those taxes on the tourism industry. So that employment rate for us is really, here in Nevada, a serious issue.
Well, you're right, Malieka. The impact of our employment is really in January and February of 2020, we had the lowest recorded unemployment, around 2.3. And 2 months later, we jumped to the highest. And like when Mike's pictures on, the Great Recession took about a year and a half to bottom. Ours went a month and a half. And so we never had experienced anything like that. And so how fast it has done, and it's going to have a lot of economic theories do not handle that. And so that's what some of the problems we're having coming out of this, I think.
Yeah, and we are seeing recovery at the US level. We did gain, like Mike said, you know, the data that's incorporated in this Nevada outlook was like 15% unemployment. And I think the last we were at 11 or 12, something like that. But when we're so dependent on the tourism industry here, I'm not sure how fast that will be able to recover because of the necessary measures to ward off COVID.
Well, that's right. And specifically, we start, even though we're talking about some gaming establishments open, many of the larger ones open, and some restaurants open, again, you got to remember, we're looking at a 50% occupancy rate that's only allowed to be filled, of what the fire marshal would normally call its total occupancy rate. We're only allowing 50% of that to be filled. Well, you cut your clientele by 50%. You still don't need as many people to service that clientele. So even in those places, if they reopen, the employment for those places, it isn't fully recovered. And added to that, a lot of places are no longer even. You know, there were a lot of companies who, to their credit, continue to pay employees. They can no longer do that. The well is run dry, and so unless they can get, you know, extended employment benefits or PUA, things of that nature, then their incomes are even hit more right now than they were at the beginning of this for those folks that are still out of work.
Just to add to Malieka's, Mike, and other things, what you're talking about, somewhat unreported, in Vegas, the station casinos, the Texas and the Fiesta, are not opening. So even though they're opening, not everything is opening. So that's what we call, I say, the new economy we're going to be bumping into.
Yeah.
All right, Bob.
Excellent. Any final thoughts before we close this one?
Final thoughts? Take care of yourself and each other. Who knows where that comes from?
I don't know.
Jerry Springer.
Oh, right.
Oh, really?
Yep, that's what he says at the end of every show.
Why do you know that?
Thank you, everybody.
Why do you think?
Thank you, and we'll see you on the next one.